comes to managing the macros or resurrecting the rupee or looking at borrowing, there is one man that the markets would want to hear, and Indian economy stakeholders are very keen to get perspective from him. I'm joined by the Department of Economic Affairs Secretary, Mr. Subash Chandra Garg, right here on the India Development Debate in a direct interview with me right here on ET Now. Thank you very much, sir, for being with us. I must begin by borrowing. You've just cut borrowing target by 70,000 crore rupees. Where is the confidence coming from? Given that you've said there will be no expenditure cut, are you confident and are you betting too big on small savings collections that will continue to go up? Will you be able to, and you'll be able to take a healthy percentage of funds from small scale savings to manage your expenditure? Isn't that too big a bet? I mean, where is the comfort coming from?
So let me just give you a broad idea of this. Our gross borrowing program was about 6,05,000 crore. Our net borrowing program is 3,90,000 crores. Our gross borrowing program, besides including the repayments and redemptions, also had an element of buyback. We had planned about 72,000 crores of buyback this year. So what we have done, and recently the small savings rates were revised, so we are expecting some additional flows in the small savings. So taking all these two together, we worked on reducing the buyback program and also taking note of the additional flows likely on the small savings. So taking these together, we decided on reducing the borrowing program by 70,000 crores. It does not at all affect our financing of fiscal deficit, which is on net basis. And there to again give you that kind of confidence that our assessment is that on the whole, on the revenue front, we are doing all right. There are some component which might be somewhat lower than the estimates, but then there are others like direct taxes and the non-tax which are doing much better than expected, and therefore on the whole we are confident. Yeah.
Okay, so the liquidity conditions in the markets have been tight in the recent weeks due to various issues, and we'll discuss some of those in just a bit. But both the regulator and at North Block, you yourself will have to continue to provide liquidity to the market, and which is why the question is, do you anticipate further hardening of yields in the second half as inflation and interest rates also move up? And if I may voice a fear that the markets have, that could you increase borrowing in the last quarter, or will off-budget borrowing through PSUs be done? Because that's what markets are wary of.
So let me again very clearly state that we don't do this kind of off-budget borrowing which you are hinting. We will not do it this year as well. There is no likelihood at this stage we see in later on revising to increase the borrowing program. As I said, we are not cutting on the fiscal deficit financing borrowing program. We are only cutting on the buyback and the additional flows which we are taking from the small savings account. On your questions about liquidity, that is a real issue which has arisen in last couple of days here in our country. In our judgment, liquidity situation requires some more sort of provision of liquidity on durable basis. We are working with the regulator and all to increase that liquidity. Regulator has taken some measures already to increase the liquidity. We would expect and work to get some more. There is another element of the liquidity where the market participants start taking certain decisions in a manner where they become risk averse, so they don't want, which also create problems about the liquidity. That is where I think I would like to believe that our markets are fundamentally very safe, secure. There is nothing, some issues which arose are very temporary. Those would be taken care, and therefore liquidity psychologically and actually both should improve going forward, and which will bring order and normalcy to the market.
Okay, sir, the reason why I asked you that question is that while, you know, I'm glad you're speaking it out, and I'm glad that will soothe some frayed nerves, but markets are wary of fiscal slippage. While the finance minister has said that there will be no cut in government expenditure, you will be short by about 1.5 lakh crore rupees as far as the GST target is concerned. At the same time, with the whole issue of the rupee depreciation, you will have to pay higher subsidy burden, which is going to go up. So expenditure is going to rise. How are you going to convince the markets that the 3.3% will be met, because they are wary of the fact that the math doesn't add up?
I don't know. See, there are always some people who go for extreme in their assumptions about things. I can't quarrel with them. And one can't really satisfy their sense of extreme uneasiness, right? What to my mind should matter and should convince people is our performance in first 6 months. We are doing, we managed the fisc in a completely normal manner. The fiscal deficit this year is lower than it was last year. And there's been this has given us confidence. You see, who would reduce the borrowing if there is any expectation of deterioration happening? You would remember last year when we did our second half borrowing program, we did not announce the 6 months program last year. We announced only 3 months program, and we said that we will take an assessment again in the month of December, and then we did another meeting and came up with the program for the last 3 months. So I don't think we will do an irresponsible, because we know for sure that in case these numbers don't turn out to be the way we are projecting, we will have a problem on our hand. And going clearly towards the end of the financial year and thinking that there would be a problem which we will create at that time is to my mind not a very elegant way of even thinking about it. We have done our maths right, we have our tools, we have our means, and therefore I am quite convinced and assured that these fiscal outcomes would come the way we have projected.
No, I empathize with your position. I also don't doubt your math. I'm just raising concerns that I should be raising, that markets have. And the other concern, sir, is I understand that you would not want to bring upon yourself something that you will have to deal in the last quarter. So on that, I grant you complete faith, complete support. But despite 2 sets of measures that the government announced, one with the Prime Minister in the saddle, and now with the Finance Minister announcing all kinds of things, the 5 policy prescription, the import duty restrictions, the visible impact both on the rupee and the market is not desirable. And that worries many stakeholders. The markets have lost nearly 2,500 points in the month of September alone. There's been a significant erosion of investor wealth. Are these points that worry you? Why do you think the markets and the rupee are not listening to the commentary, are not reading into the actions that North Block or even RBI is taking?
See, there are several forces which work at a point of time, and we are not in control of all of them, right? So some of those global developments which are taking place, some uncertainty which is related to what will happen in November about Iranian oil and all, and then some events which took place completely unconnected with the principal issues of oil, rupee, etc. In the NBFC space, and some developments in last 7 days or so. So there are all these factors working at a point of time, but despite that, in my sense, the rupee has been reasonably stable over last 4 or 5 days. It's not displaying that which we saw when it went down from 69 to 72. And my sense is that the measures which the government announced both on the current account as well as on capital account, I think are bringing some credibility to the players and some real assurance that possibly you are at a stage where unless some bigger events takes place elsewhere, we are coming to a steady state kind of situation, and that's where and I think the measures on current account announced in the form of the import duty enhancement on certain items aggregating about $15 billion will have its material impact.
Mr. Garg, I'll come to CAD in just a bit, and I understand the material impact and the reason by which the government has done it. But as far as the markets are concerned, and I will come to the specific issue, but there is a larger palpable fear in the market that many more NBFCs will default. Considering banks are not lending, NBFCs have their own stressed balance sheet, they can't go to the markets to borrow. What measures on liquidity front is the government looking to take? I mean, why can you not have a special window of sorts for NBFCs, something that has been experimented with about 8 to 10 years back?
No, see, as I said a little while ago, one is the availability of liquidity, another is the behavior of the market participants, which get influenced by certain events. And as soon as there is a realization that there is no fundamental problem, the market participants resume their normal behavior. So liquidity is being addressed by the Reserve Bank, also by the government, and we are reducing the incidence of the government's take away from the savings of the people. All these things, to my mind, should bring order in the market. The special window which you are talking, I think Reserve Bank has provided a lot of liquidity. We will take more, and so that should not be the reason why any sort of uncertainty or edginess should continue on the market fronts. They should get back to, they need assurances about the credit and other things which of their counterparts and others. I think that's what some reassessment is going on. That reassessment would be complete soon, and I think they will come back to the same conclusions that the fundamental economy and the financial system of the country is quite secure and good, and soon normalcy will return.
Sir, I want to get down to a specific issue that I have to ask you before I let you go, and that is the issue of IL&FS. Everyone and a lot of people are actually jumping the gun and even calling it India's Lehman moment, yet another Satyam and all of that. I am not a rumor monger, I am not a crisis warrior here, so I'm not going to talk about the crisis, but between September 12th to 26th, IL&FS defaulted on repayment of 7 banks. You know, as DEA secretary and somebody who looks at capital markets, government is a major shareholder here with the exposure with LIC and many other SBI being on the board having stakes. You know, this has an exposure of about 55,000 crore rupees to public sector banks. How could this epic fall of the project lender happen? I mean, this raises questions on what was the RBI doing. 2 of its reports had suspected balance sheet problems. There was a looming shadow of a default, and yet there was failure of regulatory oversight. I mean, what explains the failure to take remedial measures despite 2 reports pointing out that this was to happen?
I wouldn't get into this issue of the reports and other things, but I'll tell you our assessment. IL&FS is an important, very important entity. It is in the infrastructure space where so much is required to be done for sustaining the growth story of India. IL&FS has done reasonably well in several infrastructure space. There are a lot of government projects or government agencies which have entered into contracts with them through PPP or concession or other models, and therefore IL&FS has got a lot of public interest involved here, and the government, as the custodian of the public interest, is rightly monitoring the situation there. for last couple of days and is keeping a very close eye. We are making assessment of what needs to be done and what would be the best way to do. And very soon, as soon as this assessment is complete, adequate and right kind of appropriate measures would be announced to deal with the IL&FS situation.
Okay, so my follow-up question has to be that IL&FS says it needs 30,000 crore rupees to tide over the present crisis. What sort of a lifeline is going to be available? LIC believes it will put in the money. It has said we will. My question is, should policyholders' money be put in? And the other question is, it looks like LIC and SBI are divided over a rights issue. What is the way going forward as far as IL&FS is concerned, sir?
I don't have this kind of assessment that the number you mentioned is what is their liquidity needs or on what basis and for how much. But we are making our own assessment of what kind of liquidity gap, temporary or otherwise, exists there. And Finance Minister did make a statement about it. The LIC chairman, SBI chairman also spoke about it. And in the most appropriate way, without subjecting any of these institutions to additional risk and all, if some measures are required to be taken, those would be taken in due course.
And I'm sorry, I'm going to go all over again, IL&FS once again. My question really is, because LIC had such a strong stake there, because there was an SBI stake, they had board seats, what sort of oversight were board members and stakeholders doing? Does this not send out a worrying signal? And the other part, sir, is that, you know, everybody is talking about sale of IL&FS assets. Are we going to see that happen sooner than later?
See, I am not focused, I don't think we focus at this moment on these so-called error judgment or investigation part of it. Our concern is more to assess the real situation in the IL&FS and then to identify what exactly the measures are required for sustaining the assets and the businesses which have been created there, saving the infrastructure assets which are there, and resolving the whole situation in a way where its contribution to infrastructure space in India continues to be there in a very valuable way. So that's what is the focus of attention rather than any postmortem or any investigation at this moment.
Okay, sir. Two quick last questions. CAD could be at levels of 2.8% for the for fiscal year 19.
Yeah.
How worried are you going to be on that count? And the question is that as a reaction to CAD, we've announced a slew of measures, including a hike in import duty for 19 odd products. Are we turning our back on liberalization? Because the impact of this is going to be extremely minimal. Was this more psychologically based decision than on economic reasoning?
No, I think it's a very carefully considered decision. The items were identified after ensuring that the capital investments don't suffer, so capital goods import, etc., is not hurt. Intermediate things are not impacted, so manufacturing in India and other programs continue. The relative competitiveness of manufacturing in India vis-a-vis importing the goods should continue to be incentivized. That's what it does. And therefore, the items are very carefully selected to which are mostly the final consumption goods. And also it was seen that in these items, does the country have adequate production capacities, their capacity utilization is how much, and therefore consumption demand also is not adversely affected. All that which these measures seeks to do is to incentivize domestically produced consumption of these so-called non-essential goods and to discourage the import of these goods. I think the tweaking in duty which has been done is sufficient enough to play that incentivizing and disincentivizing role, and therefore it will have its material impact on the import into India. I have said the current account of about 1% additional $25 billion, if you can, by taking measures on current account as well as on capital account, if you can reduce the gap and then finance the gap by capital flows, we can deal with that situation.
Are there more measures on the way? Because people will say non-essential is ATF, non-essential today, that's debatable. But are there more measures on the way? Because the big culprits are gold, coal, telephones, iron, steel. They've still been left out. Are there more measures on the way? We end after this, sir.
No, that ATF is for a very specific reason that this was allowed to only some of the importers. Most of the airlines take ATF domestically, so it's not going to hurt anyone. No one's cost of being altered effectively. So that's a small item specifically, but it will contribute. If that $200 million of import of ATF is replaced by domestically produced ATF being consumed, it makes its own contribution without hurting the consumers at all or the industry at all. What additional measures? I think what has been done is material enough for the present. But if there are some more required in times to come, as I said, without hurting the growth, without hurting the production, and also without altering the incentives against manufacturing in India, that can always be thought about.
All right, sir. Thanks very much for speaking to us. It's always a pleasure chatting with you when managing macros is concerned. That's India's Department of Economic Affairs Secretary Subash Chandra Garg in
Thank
conversation
you very
with us
much.
right here at
Thanks.
now. There are concerns that are looming large on the Indian economy, but for now it looks like we will be in safe hands. A vote of confidence and perspective coming in from Mr. Garg. Thank you very, very much, sir, for being with us.